Good afternoon, everyone. Our topic is on GAAR, and I will be doing the introduction part. GAAR is an anti-avoidance rule. It is a common practice among the taxpayers to arrange their affairs in such a manner so that they will have a reduction in tax. They will use the tax benefits. At present, India has specific tax avoidance provisions embedded both in domestic tax laws and in some other tax treaties through the limitations of benefits laws. However, in the bid to slap tax avoidance and to enforce the concept of substantial overform, the Indian policymakers have introduced a more significant contemporary reform that is the general anti-avoidance rule. Tax avoidance. Tax avoidance means the tax system legally used for a person's own benefit so as to lessen his tax payable to him by the government. The avoidance of tax is done by the people who desire to keep their money with themselves and do not want to give that money to government. Avoiding tax includes situations when people eliminate or reduce tax by following a transaction or many transactions which are legal. The Income Tax Department has provided many provisions through which people can go to the tax avoidance, such as income, credit, benefits, and some other entities. Further will be continued by action.
I'm here to tell you the difference how tax avoidance. I'll tell you how it is different from tax evasion. Firstly, tax avoidance is a legal method. It is okay with the government to avoid tax, whereas tax evasion is an illegal method. It is a crime. To follow this, tax avoidance is a legal method. There will be full disclosure of material facts of tax authorities. Whereas tax evasion, you will misrepresent your details or you will conceal some information. It could be like you will not show your profits correctly, you will understate your profits, overstate your expenses so that your net profit is less and the tax you pay is less. Further, tax avoidance is like you can say it's the right of every individual to legally avoid or decrease the tax burden on such an individual. Whereas tax evasion is a crime. It's a crime in all cases. It could lead to imprisonment, it could lead to fines. There's one interesting fact where in the US, thieves have to report their stolen money, the income that they earned from stolen money. So when these thieves are caught, obviously the thieves will not report their income that I've stolen this much money. So when they are caught with that, they will be charged with tax evasion. So obviously they will not file their return and they have tried to do that. Lastly, let me say GAAR is an antidote for tax avoidance and not tax evasion. Because GAAR will need to be kind of reported, and tax avoidance is where you would have reported everything to the tax authorities. So they will know what are the loopholes they're trying to probably taken to avoid tax. When tax evasion is not reported at all, so GAAR will not be able to put a control on those aspects. So other two questions.
Let's see what are the methods used by multinational companies to avoid taxation. Firstly, let's see what is multinational company. It is a company which is operating in more than one country. For example, it is IBM. IBM has a headquarters in the USA, then it is operating all over the world. The first method is avoiding being a residential company or high tax country. The country usually has to pay a tax in a country which is incorporated. The residential company in a high tax country has to pay higher taxes than that of those tax countries. Therefore, this multinational company reduces its international taxes by avoiding being a residential company of high tax countries. Nextly, let's see capital structure planning. Applicable laws and regulations may also play an important role in capital structure decisions. Since debt payments are allowed as tax deductible, it will be deducted by the high taxes. The company has high tax rate, it will be deducted from that. So automatically your tax burden will be decreased. Then let's see currency swap. It is an agreement between two parties or two countries for exchanging principal and interest in one currency for the same other currency. Next is perform tax avoidance by a transfer pricing mechanism. Multinational companies perform tax avoidance by transfer pricing They transfer their profits from a high tax area to low tax area. That means multinational companies report their profits in low tax countries, even though they earn the actual profits in high tax countries. Then next one is actualized tax avoidance by international tax shelters. This is a tax shelter usually means an investment that involves losses in the near term, with the hopes of significant gains in the future term. Over to you.
Tax advantage over international tax companies. In order to avoid international double taxation, usually the countries will enter into a bilateral contract or a bilateral convention called double taxation avoiding agreement. In this, the countries will get certain amount of concession. The contracting countries will get certain amount of concession, like tax abatement or tax deduction for agriculture. Reverse tax avoidance. Usually, in common international tax avoidance, the taxpayer will prefer to enter low tax rate countries and not high tax areas. But in this reverse tax avoidance, the taxpayer will enter high tax areas. So, in order to get certain amount of benefits or interest, the main target of this reverse tax avoidance is to get more benefits from paying more tax. Third is tax deduction. In this, the company should identify the expenses of incentives included in the expenses of the company's research activities, and this includes national and rural credits or regional credits, and enhanced deduction for research expenses. Deductions are also allowed for setting up companies in SEZ units or setting up companies in rural areas. Next one is actualized tax avoidance by tax debtors. Only when the mother company receives dividend from the child company, it should pay tax to the company where it leaves. Therefore, the mother companies can delay in the repatriation, like occupying the profit from the child company. Accounting method and inventory method. In this, the company will show the cost of goods high by showing more depreciation or more labor costs, etc. So when the cost of goods is high, the profit of the company will be less, and the tax which the company pays will be less. Over to
Good afternoon. We continue the methods that MSC companies use to avoid taxes. As you all know, MSC company has those countries in which are working more than one country. Why will a company do such a thing? In order for a company to get more profits, they need to find other opportunities which will make them to earn more profit. So, there are a lot of methods that you can use to increase your revenues and increase your profits. One of them is to avoid paying tax. You can either avoid paying tax either legally or illegally. One of the methods that multinational companies can use is underreporting. What do you mean by underreporting? A company can decide to understate their incomes and revenues and overstate their expenses. At the end of the year, their profits, operating profits will be low, and the tax which will be charged on them will be low tax. The next point is arbitrage. Arbitrage is a legal method that companies can use to avoid paying tax. How? You just play with the differences in localities, or let's say geographical locations of the trade. Let me give you a good example of arbitrage. You own shares in National Stock Exchange, NSE, and you own shares in Bombay Stock Exchange. If today you realize in National Stock Exchange the prices of your shares are 1,000, and then in Bombay Stock Exchange they are 900. You can just do a trade of selling your shares in National Stock Exchange and buying those ones of Bombay more, whereby the 100 rupees which will be a profit. So companies, they like to use this kind of thing, like during taxation, they can decide to buy stocks of high prices so as in their books of accounts it should show a low profit in order to pay less tax. Point number 3 is rollover. Rollover is a legal term whereby small companies are given concessions to defer their capital realization, whereby they can decide to roll over their capital assets for as many years they want. Instead of paying just for this year, you can defer it to the next year. And you can roll over as many assets you want. Many companies, they decide even to roll over almost all their assets so as the capital revenue on their assets will be zero. At the end of the day, they don't pay tax on their assets. The next point is tax cheat. Tax cheat is a illegal means of avoiding tax. Like all know the meaning of cheat. So over here you can use all the dishonest means, fraudulent acts to avoid paying tax, following the rules of taxation. Tax cheat and the first one, which is under reporting, if you are caught, you can result into a lot of penalties, and if you have exceeded the limit, you can go through even criminal cases. Your company may be even bankrupted or any other means of the government. The next one is tax shield. Tax shield is these are concessions which are given to small companies so as to reduce their accessible value, accessible income, which should be charged tax. Whereby some companies can decide to apply for mortgage loans, interest for their workers, so as to reduce their net income at the end of the year. And then when they reduce their net income at the end of the year, the tax is low. The last point is postponement of realization of capital gains. As we all know, capital gains are charged tax only when they are realized. So companies will decide to do like, well, no, the end of the financial year is March 30th. You can decide instead of realizing your capital assets, capital gains at March, you can decide to realize them in April. So at the end of the March, when you are closing your books of accounts, you have a low income. So there will be no tax on capital gains. These are the methods that are used by MNC companies in the world. I'll pass over to Patrick.
We will discuss something provisions of general anti-avoidance rules. First one will be the provisions targeting transfer of income without transfer of an asset. Here the MNC companies, what they do is the assets of the MNC will be here and the income which will be transferred to the no avoidance of the tax, which is outside India or some other countries. And in respect of the irrevocable assets also, it will be the same case. And relating to clubbing of incomes, which will prevent shifting of income from one person to another person for transfer of for tax reasons. Here the clubbing of income will be done for the avoidance of tax, which will be less than the, which will be transferred or clubbed with the income with person who is not having a major source of income, so the tax will be avoided. And targeting avoidance of tax by the resulting transfer of income to non-resident Indians. The person who is resident of India can transfer his income to non-resident India and avoid tax on those transactions, so that if the tax is which is higher in India, it will be reduced in that country as per the dual transaction. And tax avoidance of targeting avoidance of tax by certain transactions in securities such as dividend stripping and provisions authorizing the assessment officer of determining actual cost of the assessee in case of transfer of assets with a view of claiming higher depreciation at the enhanced cost. Provisions meant to plus good tax avoidance in case of sale and lease back transactions. And provisions of good tax avoidance by transferring property at nil or inadequate consideration. And in case of T.K. Abukar, the assessee is an MD of a company where he had given his property as a rent for golden purpose, and it got destroyed in 1981. And the assessee take advances on Indian rupees as 10 lakh rupees, and it was further divided as the advances of the rent. Further, it was adjusted as advances as the rent. The assessment officer did that it is to be the deemed dividend, and the High Court of Kerala upheld that it couldn't be the dividend of it will be adjusted against the rent in the advances of the future years. And it will over to Charlie.
I'll be sharing with you the proposals that are to be input in the present GAAR. The Commissioner is empowered to declare an arrangement as an impermissible avoidance arrangement if the whole or a step or a part of the arrangement has been entered with the objective of obtaining tax benefit. In the Indian Income Tax Administration, the Commissioner of Income Tax is the head. So he will be having the powers to point out whether your arrangement is an impermissible avoidance agreement or not. The rules will not be specific to any country or asset class. It will be applicable for all foreign portfolio investments. People are using tax havens like Mauritius, the Cayman Islands, the British Virgin Islands to avoid taxes. So, because of these tax havens, the government is trying to implement GAAR, which is common for all countries, and they want to avoid and they want to implement these rules, which are common for all countries, just because of the tax havens. The onus to prove whether it's a case of tax avoidance or not will be on the taxpayer. In most of the GAAR countries like Canada, the South Africa, and all, this rule is something different. The onus to prove whether it's a case of tax avoidance or not will be on the tax revenue department. But only in India they are trying to change it, and they want to put the onus on the taxpayer. Lacking commercial. Further, the Finance Bill of 2012, it proposed introduction of subsection 2A to section 90, which would enable the provisions of GAAR to override the provisions of the tax treaties signed by India. So, India have already signed more than 80 tax treaties with most of the nations, but with only GAAR, this GAAR, which is not even crafted properly, they want to override all the other tax treaties and come up with GAAR. Lacking commercial substance, defined to include situations where there is a significant tax benefit without a significant effect upon businesses or net cash flows. Legal substance or effect differs from legal form. It also includes round trip financing, any accommodating or tax indifferent party, any element that has the effect of offsetting or cancelling each other, a transaction which is conducted through one or more persons and disguises like nature, location, source, ownership and control of funds. According to a report in the Economic Times, the government could tweak the dreaded GAAR to exempt small firms, and they wanted in this tax bracket they didn't want to include the transactions which were less than 15 crores. But the retrospective concept is scaring away the private equity investors, the global funds, and the investment houses. A couple of them have shifted already to Singapore, and many of them are trying to change their nation. So it's better advised that GAAR is properly drafted out before it comes into implementation. Over to
My topic is positive impact of GAAR on the state. The main purpose of GAAR is to obtain a tax benefit so that it satisfies the two specified that it should not misuse of tax on commercial substance. The commercial substance is where the concept where it is used in transactions which have no effect and which from that it generated profits and revenue, and the purpose of making tax law should be in a good way. The tax system encourages from high tax to low tax that as a jurisdiction exists if the home country exists foreign source income. The introduction of GAAR is to attempt as aggressive tax planning and treaty shopping among foreign and tax implementing developing countries, so that it end attractive tax planning and stopping the contracts with the foreign tax the treaty among foreign and also brings the tax benefit to the India, so that it is also helping for the developed economies. And also the GAAR also broadens the tax base and extended to India to react over foreign companies. GAAR typically leads to low tax in capital importing countries. Capital importing companies is where the specific countries will borrow the money on that which the tax is paid low, like such as interest, dividends, royalties and capital gains. Negative impact of GAAR on FDI. Due to introduction of GAAR, countries claim a large amount of revenue drawn on border projects. The emergence of third countries that have own ways to tax basis by transferring the existing international tax law. TTC play a negative impact on foreign direct investment on short term. It is less where the existing law has a less clarity among the tax rules and is also implemented in a negative impact on FDI. The GAAR provision is also seeks out the tax evasion scheme. The existing tax provisions which are due to tax evasion and previously made use of DTA, that is double tax avoidance agreement, which would be a serious backdrop of foreign investment. Over to Adnan.
I'm here to explain about international experience. GAAR in Canada. GAAR in Canada was introduced in 1988 from the Canadian tax law, which was stated that it was noted that it is intended to produce a big tax avoidance at that time, or arrangements that at the same time it prevents interfering with the business promotion and family transactions. That's what the government said. Also, it posted in the new rules to distinguish between the different tax planning and the abuse tax avoidance and establish a reasonable balance between protection of tax paid and the tax and the taxpayer and the planning of their affairs. Also, in Australia, GAAR was introduced in 1981 from which contained Part 4A of Income Tax Act 1936. Also, it proposed a provision about its new part, seeking to give interest of police that such measures ought to strengthen blanket efficient preventing arrangements that have unnecessary. In Australian GAAR, it's not here, and in Australian GAAR, the provision was in last resort, means it should not apply unless the taxpayer claim is otherwise allowed, and therefore the counter scheme is strictly confined in certain requirements of the tax law. But it's also, that's what I was explaining about this provision in the last resort. Not apply unless the taxpayer is still otherwise allowed. Therefore, it is counterfeit strictly applying the federal government of the tax regime to any provision under ADP. Also, GAAR is applicable in South Africa. In South Africa, it's also in the part of their income tax legislation. During 2006, the income tax of 1962 was amended so that it allowed the GAAR to be insular services. The GAAR contains in Part 2 of the Chapter 3 of Income Tax Act, which implies that avoidance arrangements and provision against the tax avoidance applied by the first regime impermissible avoid agreements that have entered into the sole or main purpose scheme obtaining the tax benefits in the context of the business. That means it will enter into or carry out in a manner that normally it implies the bona fide of this business purpose and other than the obtain the tax benefits. Also, it's lack of commercial cash flow. But also, in the context other than the business, it will enter into the carry of outside use of the manner or normally includes the bona fide purpose to obtain the tax benefits. Thank you.